we say that EPS is a method used to value publicly traded companies. If you want to invest in any company, you need to check the performance of that company. You need to check on the performance. Therefore, to check on the performance, we have some variables that you will use as an investor. Like you check, do this company pay dividend, and how do they consistently pay dividend? Therefore, you check on their dividend per share over some several years so that you know if this company can pay dividend consistently. Then also you check on earnings per share. If I invest my 1,000 shares there, how much will a share increase every year? Therefore, you also check on earnings per share each year. Therefore, we say that in EPS, we have two types of EPS. We have two types of EPS. We have basic EPS. We have basic EPS. Then we have diluted EPS, diluted EPS. We have basic EPS and diluted EPS. And as a recap, we say that basic EPS is the exact EPS of the company during the year. Basic is the exact. How much is my EPS at the end of the year? Therefore, basic EPS equals to PAOS. PAOS is a profit attributable to ordinary shareholders divided by PAOS. PAOS equals to profit attributable to ordinary shareholders, you divide by 1/OS. 1/OS is the weighted average number of ordinary shares. And the reason why we call it 1/OS is because we are going to weight shares on either time basis or on cash basis, either on time basis or on cash basis. That one we said. Then on diluted EPS is the futuristic EPS. How will our EPS, this basic that we have, how will it look like in future? I believe there we are okay up to there. How will our EPS look like in future? Therefore, here diluted, here we say we use potential ordinary shares. Potential ordinary shares. We are going to check on potential ordinary shares. And what are the potential ordinary shares? These are the instruments that will give us the right to get ordinary shares in future. For example, we have convertible instrument that will guarantee us ordinary shares in future. Therefore, in that case, if I have potential ordinary shares, we call them dilutive factors. Dilutive factors. Dilutive factors. What are the examples of dilutive factors, potential ordinary shares? Number one, convertible preference and debentures. Convertible preference shares and debentures. Number two, stock options. Stock options. Then number three, we have what we call contingently issuable shares. Contingently issuable shares. Those are some of the dilutive factors that will cause our EPS in future to change, our basic, because we know that today it's a preference share, but tomorrow it will be an ordinary share. You are going to convert, therefore you are going to increase what? The number of shares. Therefore, Caroline, you are saying, kindly switch off your video. Kindly, if your video is on, you can switch it off so that we don't get a background disturbance. Which question are we doing? Let's touch a bit. We are doing the question of May 2019, question number 4. Thank you for B. Thank you. Thank you very much. Be your sisters and brothers keeper. Therefore, here, good friends, we want to look at this question quickly. May 2019, question number 4, quickly. May 2019, question number 4. B, number 4B. Those who will be coming, they check on the board, you will say. Therefore, this question number B says, Dewey Limited has produced, Dewey Limited, my paper is not clear, has provided the following info extracts from its income statement for the year ended at 1st December 2017 and 2018. Has provided the following extracts. Now we have the extracts, profit before tax, we have it there, 950 1550. Then we have income tax expense, 500, 900. Profit after tax, 450 and 650. And 650. Then we have capital structure there. On the capital structure, we have ordinary shares of shillings 100 each, 2,000, 3.3. 10%, 8% redeemable preference shares of shillings 100, 1,000, and 1,000. 10% convertible preference shares of shillings 100 each, 500, 500. 10% convertible loan stock of 1,500, 1,200. Additional information, note number 1. Note number 1, let's go slowly. Part of the increase in the share capital ordinary was due to the rights issue that was made on 1st April 2018. Therefore, it means in the 1st April 2018, what did we do? We made a rights issue. We say that in a rights issue, we have shares that will be at full market price, and we have the bonus element in a rights issue. Shares at full market price, you wait on time basis. Bonus element, you don't wait on time basis. Then a shareholder was granted the right to buy 1 new ordinary share for every 5 ordinary shares held at a price of shillings what? 120 per share. The market price of the ordinary shares before the rights issue was 125 per share. Number 2, the convertible loan stock was issued on 1st July 2017. Each shillings 1,000 loan stock is convertible to 25 ordinary shares. Holders of shillings 300 million worth of convertible loan stock exercise their right on 1st January 2018. Number 3, the convertible preference shares were issued in the year 2015. 1 convertible preference share is entitled to 1 new ordinary share. Number 4, meanwhile, on 1st April 2018, the company granted its employees the option to buy 4 million ordinary shares at a strike price of 120 per share. No employee had exercised their right by that 1st December 2018. The average market price of the ordinary shares during the year 2018 was 125. The corporate tax rate is 30% required. The basic EPS for year 2017 and 2018, then the diluted EPS for year 2017 and 2018. Therefore, quickly, let's look at the basic EPS 2017. We are beginning with 2017 basic EPS, which equals to basic EPS. Basic EPS equals to powers of a one-us. That is our formula. Then, how do I get powers? Profit attributable to ordinary shareholders. How do I get it? I get profit after tax, I come to less preference dividend. Now, when I check in 2017, kindly let's check in 2017. How much is our profit after tax? Profit after tax, examiner is telling us 450. Profit after tax, examiner is telling us it's 450. Then we come to less preference dividend. And kindly, we have here 2 dividends that we are going to pay. We have number 1, 8 from our capital structure. Let's check in our capital structure. We have 8% redeemable preference shares of shillings 100 each, and 10% convertible preference shares of shillings 100 each. Now, I believe I explained something here, that when we have redeemable preference shares, redeemable preference shares, this is always treated as a finance cost. I believe we are together there. When we have redeemable preference shares, in the income statement, dividend on redeemable preference shares is treated as a finance cost. Is treated as what? A finance cost. Therefore, before I get profit after tax, this one, I subtracted interest, which is a finance cost, and redeemable preference share, Therefore, I subtracted those 2 items. We are required to treat it as a finance cost. Therefore, that dividend on redeemable, we subtracted it before what? Profit after tax. Therefore, that one is not going to affect our capital structure there. It is not going to affect us here because we already subtracted. Here we are only going to subtract convertible, or if you have irredeemable. Remember, we have two types, either irredeemable or redeemable. Irredeemable is a capital because it will be in the company for unforeseeable future. But if it is redeemable, it means in 1 or 2 years, you are going to buy it back. Therefore, that is a finance cost. We treat it as a finance cost, the dividend that we are going to pay. Therefore, here I am only going to take 500 times 10%. Therefore, I get 50. Then I get my powers, which is for 400, my powers. I believe we are together there of what I explained, that redeemable is a finance cost. Therefore, the moment you get profit after tax, you already subtracted that. Unless examiner gave you the full income statement, you are preparing the full income statement, that one you are going to subtract it. But if you have profit after tax, redeemable preference shares, you leave it alone because it was already subtracted. Therefore, there we have our powers. Then we go to one-offs. We go to one-offs. How do you get one-offs? In 2017, our shares that we have there is ordinary shares, capital structure. Let's check in the capital structure. Ordinary shares that we have in 2017, we have 2,000 shillings, 2,000. But remember, shillings 2,000 is already in shillings. Therefore, we put it in shares by dividing by the bar value. Therefore, we say one-offs 2017. One-offs 2017. One-offs 2017, we say particulars, number of ordinary shares, number of ordinary shares. Then we say the weight. Then we go to one-offs. That is in 2017. 2017. I believe you are doing that. You are doing that quickly. Now that you have the concept, I believe you are doing that quickly. One-offs, number of ordinary shares, the weight, and therefore we go to first. When are we beginning the year? We are beginning the year on 1st of January. On 1st of January, because we are ending the year on 31st December. We are ending the year on that 1st December. Therefore, 1st of January 2017, existing shares. We in the capital structure there, we have 2,000 divided by 100 per value. Therefore, we have 20. We have 20. This one we are not going to wait. Therefore, here we have 20. I believe we have seen we have 2,000, but that 2,000 is in shillings. Therefore, you divide by the bar value, which is 100, to get the number of shares. To get the number of shares from the capital structure. Then we go to note 1. Number 1, what happened in 2017? Note number 1 says part of the increase in the share capital ordinary was due to the rights issue that was met on 1st April 2018. Note 1 is talking about 2018. Therefore, it will not affect our one-offs in 2017. It is talking about 2018. Note number 2, the convertible loan stock was issued on 1st July 2017. Each shillings 1,000 loan stock is convertible to 25 ordinary shares. Holders of shillings 300 million worth of convertible loan stock exercise their right on 1st January 2018. Therefore, it's also talking about 2018. And kindly listen to this, is very important. We have the difference between when we issued a debenture, issue of loan stock, and conversion of loan stock, Issue of loan stock means, I'm explaining this because 3 or 4 students have inboxed me to ask what is the meaning, the difference. Therefore, the difference between the issue and conversion. Issue, we are releasing our debenture to the market. We are issuing the debenture. We are getting the debenture in the company. We are issuing the certificate to get the money as a debenture. Therefore, issue means we have a debenture. But conversion means we are converting a debenture into ordinary shares. Therefore, I can issue debenture on 1st July 2018, for example. 2018. This is a debenture. It's not an ordinary share. I issued a debenture. But now to convert it in ordinary, it will depend when did I convert to ordinary shareholders. Conversion, I'm making a debenture to be an ordinary share. Therefore, there's a difference between issue. Issue means of a debenture means I'm getting the debenture in the company. I'm taking the debenture in the company alone. I'm taking a loan in terms of debenture. But conversion means now I'm converting this debenture into ordinary shares. And Felisa, you are saying 2000 is at the end of the year. At the end of the year, that is what we have at the end of the year 2017. In the year 2017. Now let's check in note number 2. The convertible loan stock was issued on 1st July 20. Here we have discussed. We converted on 1st January 2018. Therefore, it will not affect us in 2017. It will not affect us in 2017. Number 3, the convertible preference shares were issued in the year 2015. One convertible loan preference share is entitled to one new ordinary share. Therefore, we have preference share, but we did not convert into ordinary share. Did we convert? If you read in that note, did we convert anything? Yes, we did not convert anything. Therefore, it is not an ordinary share. Then number 4, meanwhile, on 1st April 2018. Therefore, you find that in 2017, this is the only shares we have. Those are the only shares we have. Therefore, our EPS 2017 equals to 400 divided by 20. We are getting shillings 20. Shillings 20. We are getting shillings what? 20. We are getting shillings 20. Therefore, that's our EPS 2017, sorry. Therefore, let's go quickly to 2018. After we have this, let's go quickly to 2018. 2018. If you have any question, let me know. Let's go quickly to 2018. 2018. EPS 2018. 2018. Now, 2018 EPS equals to powers of awareness. Therefore, my powers 2018 equals to profit after tax. Profit after tax. Profit after tax, I have it as 600, 650. 650. I come to less preference dividend. Preference dividend. Preference dividend, which is still 500 times 10%, which is 50. Therefore, I'm getting 600 as my powers. My powers. My powers. Jamie, you are saying share split in note number 1. Share split, note number 1 is not a share split, it's a rights issue. Jamie, is not a share split, it's a rights issue. It's a rights issue, it's not a share split. Therefore, this is my powers. Then I come quickly to compute. I come quickly to compute my wanos. Wanos. Quickly to compute wanos. I say particulars. Number of shares, number of ordinary shares. I put the weight, then wanos. Wanos. Quickly, I believe we are doing it quickly. Why are we not using the redeemable preference shares? Esther, I already explained and I said, redeemable preference shares, Esther, redeemable preference shares are treated as a finance cost. Redeemable preference shares are always treated as a finance cost. And for you to get profit after tax, you always subtracted interest. Interest is a finance cost. You subtracted redeemable preference shares. Redeemable preference shares is treated as a finance cost. Because in the company, I have preference shares, but it's just there for 1 or 2 or 3 years, and then I buy them back. Therefore, those ones we don't treat them as capital per se, but it's a liability. It's a liability, we are going to redeem it. Therefore, the dividend, we treat it as a finance what? Cost. Therefore, before we get profit after tax, we already subtracted that redeemable preference shares. I believe it's okay. I'm just repeating what I said. Okay, let's go to WANOS 2018. Now, one was 2018. We started the year on 1st January 2018. 1st January 2018. On 1st January 2018, on 1st January 2018, existing shares is 20. The one from 2015, that from 2017. The closing balance in 2017 is the opening balance in 2018. I put a dash, therefore I have 20 there. I have 20 there. Those are the existing shares. Then I go to what happened in 2018. And in 2018, kindly, we need to go with the chronological of events. Chronological of events. Which came first? Which came first? Chronological of what? Events. Therefore, we are saying here in note number 1, we did a rights issue. But rights issue was on 1st April 2018. Rights issue was on 1st April 2018. Therefore, on note number 2, I believe we are okay with note 1. We have the rights issue that happened in April 2018. But when you check in note number 2, we have the conversion of loan stock, which happened on 1st January. Therefore, we say 1st January. 1st January 2018. What happened? Conversion of what? Conversion of loan stock. Conversion of loan stock. Conversion of loan stock. Do you pay dividend on redeemable preference shares or convertible preference shares? Alice Macau, you are saying, do you pay dividends on redeemable preference shares or convertible preference shares? We pay on both. We pay on both dividend, we pay on both. But the treatment in the income statement is different. The treatment in the income statement is what will make a difference. But we are going to pay dividend, yes. Alice Macau, we are going to pay dividend, yes, but the treatment is different. If it is irredeemable, we have what we call irredeemable. I believe you are following irredeemable preference. We have what we call redeemable preference. Then we have what we call convertible preference. We have what we call convertible preference. Therefore, irredeemable preference and convertible preference, this one, their dividend, we are going to subtract them after, because we regard them as capital. We are going to regard them, to deduct them after profit after tax in the income statement. After profit, after tax, then we subtract those ones. But redeemable preference dividend on redeemable preference shares, what I'm saying and I'm insisting, we treat them as a finance cost. We treat them as a finance cost. Therefore, before I get profit after tax, I have already subtracted interest and I have already subtracted what? Redeemable preference shares. That's how we treat them in the income statement. I subtract them together with the interest, Therefore, we treat it as a finance cost. That is what I explained. That's what I explained. I'm repeating this item. I don't know why. Therefore, here, 1st January 2018, conversion of preference of loan stock, conversion of loan stock. Here we are going to convert loan stock. Therefore, for every what you get what? Conversion of loan stock, number 2, and note number 2. Conversion of loan stock. The convertible loan stock was issued in July 2017. Each shillings 1,000 of loan stock is convertible to 25 ordinary shares. Holders of shillings 300 million worth of convertible loan stock exercise their right on 1st January. Therefore, on 1st January, for every 1,000, I get 25. What about 300? It will be 300 times 25 divided by what? 1,000. How many shares do I have there? How many shares, Generous Kananu, how many shares do I have there on conversion of loan stock? How many shares do I have? 7.5. Thank you very much. 7.5. Therefore, these shares were issued on 1st January. Therefore, they will be in the company for the whole year. They will be in the company for the whole year. Therefore, they wait. We don't wait them. 7.5. 7.5. They will be in the company for the whole year. Then kindly we go to note number 3. We go to note number 3. We go back to note number 1. We go back to note number 1. I believe we are there. Go back to note number 1. They say, part of the increase in the share capital ordinary was due to the rights issue that was made on 1st April 2018. A shareholder was granted the right to buy 1 new ordinary share for every 5 ordinary shares held at a price of shillings 120 per share. The market price of the ordinary share before the rights issue was 125 per share. Therefore, here we are going to do on 1st April. 1st April, we are going to do the rights issue. We are going to do the rights issue. And in the rights issue, we have shares at full market price, shares at full market. Then we have the bonus. We have the bonus. We have the 2 things there. We have shares at full market price. We have the bonus. Therefore, for us to get the shares at full market price, first we are going to compute a price called theoretical X right price. Therefore, let's do a working for the rights issue. Working for the rights issue, kindly. Working for the rights issue. In the rights issue, I have how many shares am I getting? Examiner is saying for every what you get what? What is the ratio? By 1 new ordinary share for every 5. For every 5 shares, I get 1. What about what? Here I have 20 plus 7.5. 20 plus 7.5, I have 27.5 shares. Those are the shares I have outstanding as at 1st January 2018. Therefore, if I'm to issue the rights issue, I base on the shares I have here. Therefore, what about 27.5? 27.5 is the addition of 20 plus 7.5. Therefore, it will be 27.5 times 1 divided by 5. How many shares are there? How many new shares do I have? 5.5. Catherine Joki, thank you very much. 5.5. Thank you very much. Thank you very much. Thank you very much. 5.5. Then I do what we call shares at full market price, or theoretical X right price. Theoretical X right price, which equals to theoretical X right price. My shortcut is for every 5 shares, I get 1. For every 5 shares, I get what? 1 ordinary share. I'm computing the theoretical using a shortcut. Therefore, 5 shares goes at 125. 1 share goes at 120. I'm using the shortcut to get the theoretical X right price. Theoretical X right price, I say for every 1 share, I get what? I get 1. For every 5, I get 1. 5 shares goes at 125. 1 share goes at 120. Therefore, here I'm going to get 6 what? 625 total. When I multiply this one, I multiply. This one also I multiply, I get 120. Therefore, total shares here, I'm getting 6. Total shares here, I'm getting 745, if I'm not wrong. 745. For every 5 shares, I get 1. 5 shares, market price is 125. 1 share is coming at 120. Therefore, my theoretical X right price is ngapi? Theoretical X right price is ngapi? I will take 745 divided by 6. For every 5 shares, you get 1. 5 shares goes at 125, the market price. 1 share is coming with 120. Then you add 124.17. 124.17. That is my theoretical X right price. That is my theoretical X right price. That is my theoretical X right price. Now, I get the shares at full market price. Shares at full market price. I believe you are writing shares at full market price equals to value of new shares divided by theoretical X right price. Divided by theoretical X right price, which equals to a value which is 5.5 times 120. 5.5 is the new shares times 120, the market price, the shares we issued at 120 to get the value. Then I divide by 124.17. Value of new shares, unachukua new shares 5.5, we issued them at which price? We issued them 20 plus 7.5, yes. And Nekesa, you are saying, where is 27.5 coming from? Where is 27? 27, we quoted our shares outstanding as at 1st January. We started by 20 million shares, 20 million shares. Here, on 1st January, we converted shares 7.5 shares. Therefore, we have 27.5 shares outstanding when we are going to do the rights issue. We have 27.5. Therefore, we are issuing the rights issue there. It means some people are not following what we are doing. Some people are not following what we are doing. And that is very wrong. That is very wrong. Therefore, Felista, you are saying 5.32. 5.32. Those are shares at full market price. Shares at full market price. 3.52. Therefore, the bonus element, bonus equals to 5.5 minus 5.32. Bonus element equals to 5.5 minus 5.32. Bonus element. Therefore, here we have 0.18 bonus. 0.18 as bonus. Therefore, I come here, shares at full market price, I have 5.32. This one I weight on time basis. Bonus element 0.18. I don't weight. Therefore, the one-off is that way. The one-off is 0.18. This one I weight on time basis. Therefore, I count month. I issued on 1st April. Therefore, I weight on 9 over what? 9 over 12. 9 over 12. We do it on 9 over 12. 9 over 12. 9 over 12. Therefore, one-off itakuwa ngapi? How much is our one-off? One-off 3.99. 3.99. 3.99. That's our one-off. Then we are done. We are done. You give me the one-off hapo. You give me the one-off because in note number 3, it talks about convertible preference shares, which we did not convert. Then note number 4 talks about loan stock. It talks about loan stock, of which we did not exercise. It's a potential ordinary share. Therefore, those are the shares that we have for basic EPS. For basic EPS, those are the shares. 31.67, 31.67, 31.67, 31.67, 31.67. Then we go to EPS equals to 600 divided by 31.67. 31.67. How much is our EPS? How much is our EPS? 18.95. 18.95. Then good students, because we have the rights issue, kindly listen to this, is also very important. Because we have the rights issue in the year 2018, but in year 2017, we did not have the rights issue. Therefore, what we are going to do, we are going to restate the EPS of 2017. We are going to restate the EPS of 2017. Why? Because in the 2018, we have the rights issue, but the rights issue was not there in 2017. Therefore, we assume if suppose the rights issue was in 2017, how will our EPS look like? Therefore, we say restated EPS of 2017. Restated EPS of 2017. Restated EPS of 2017. Restated EPS of 2017. 2017. restated EPS of 2017. When we have the rights issue, you are required to restate the previous year EPS. How do we restate? Restated EPS equals to you take the previous year ones, previous year EPS, you take equals to, we take previous year EPS times this factor X right price divided by CAM right price, divided by CAM right price. X right price divided by CAM what? CAM right price. Therefore, our previous year EPS was 20. Our previous year EPS was 20. We multiply by X right is 124.17 divided by CAM right, which is 125. CAM right price is the existing price before the rights. CAM right price is the existing price before the right. X right price is the theoretical X right price. The price we assume it will prevail after the rights issue. Therefore, what will be our restated EPS? 19.87. That's our restated EPS of 2017 as at 2018. Whenever you have the rights issue, you are going to restate your previous year EPS. How do you restate it? You take the previous year EPS, you multiply by the X right price, divided by the CAM right price. Then you have restated your EPS of 2017. That is basic. Let's go to diluted. Diluted EPS. I believe we are okay there. Let's go to diluted EPS. Diluted EPS. Now, when we go to diluted, what are you going to dilute? We are going to dilute the basic EPS. Diluted EPS. Let's go to diluted EPS. Diluted EPS. I believe you are writing diluted EPS. Negesa, I believe wherever you are writing diluted EPS. Then in diluted EPS, we identify potential ordinary share. You identify potential ordinary shares. We identify potential ordinary shares. What are potential ordinary shares? Shares that we have not converted or issued during the year. Those are potential, where you see that this is still a debenture, this is still a stock option, this is still a preference share. Then in the future, they will convert. We call them potential ordinary share. Example of potential ordinary share, examples, we mentioned them. Convertible instruments. We mentioned them, we said stock options that has not been converted, stock options. Contingently issuable shares, contingently issuable shares. Those are potential ordinary shares. Therefore, we check in our question kindly. If you want to compute diluted EPS, do I have any potential ordinary share? Now, in note number 1, it is the right issue. The right issue, we have converted it into a right and into shares. Therefore, it's not a potential ordinary share. We go to note number 2. Note number 2, we have a convertible loan stock. That convertible loan stock will give rise to a potential ordinary share if you have not fully converted into ordinary shares. Like when you check in note number 2, we only converted 300 out of 1,500. Therefore, it means that we have potential ordinary shares. What you have not converted into ordinary share during the year, then it becomes potential ordinary share. Then when we check in number 3, we have convertible preference shares that were issued in the year 2015. Therefore, up to now, we have not converted into ordinary shares. Therefore, it's a potential ordinary share. Purity, you are saying, what is our previous year EPS? Our previous year EPS was shillings 20. We already computed. Thank you, Peter, for helping Marimu there. Then, when we check on note number 4, note number 4, we have stock options. Did they exercise? They did not exercise. Therefore, if they did not exercise during the year, then they will exercise in future. It's a potential ordinary share. A potential ordinary share. They will exercise in future. Therefore, we have 3 potential ordinary share. Number 1 here in our potential ordinary share, number 1 is convertible loan stock. That is number 1, convertible loan stock. I believe you are writing convertible loan stock. Convertible loan stock, I believe you are writing convertible loan stock. Purity, I believe you are writing convertible loan stock. Therefore, on convertible loan stock, we check on number A, incremental earnings. Incremental earnings. What is an incremental earning, good friends? What is an incremental earning? The saving you are making on conversion. Like, for example, good friends, on loan stock, I'm paying interest. Each year, I'm paying interest. When I convert, will I pay interest? No, I will not pay it. Therefore, it becomes what? A saving. That interest that I will not pay becomes a saving. Therefore, when we check on in this debenture, note number 2, the convertible loan stock was issued on 1st July 2017. On 1st July 2017, each shillings 1,000 of loan stock is convertible to 25 ordinary shares. Holders of shillings 300 million worthy of convertible loan stock exercise their right on 1st January 2018. Therefore, here, who can give us the interest we are going to save on conversion in 2017? We are starting with 2017. Who can give me the interest that I'm going to save on conversion of that? How much is our interest we are going to save on conversion? Kindly help Mwalimu there. How much is the interest we are going to save on conversion of loan stock in 2017? Kindly help Mwalimu there. Help Mwalimu. The interest that we are going to save on conversion. You are saying 300, 150, 150, 150. Thank you very much. You are saying 150. We started by 84. We have 84 there. We started by Sylvia. You are saying 300 times 10%. Really, Sylvia? 300 is the one we converted. We converted in 2015. We converted 300. Nana, you are saying 10% of 15. Good trial. Caro, you are saying 150. Karl Marx, you are saying 150. Johnny Barasa, you are saying 84. Ruth Wambuyi, you are saying 150. Caroline John, 150. Stella Makashi, 150. Nekesa, 150. Linda Kenti, 120. Velista, 120. Zamsam, 75. Penina, 25. Fictat, 75. Jamie, 1,500 times 10%. 750. Sylvia, I have seen 21, 12, Nancy Wamunyu, 120, 120, 75. Okay, Linda Wanjira, you are saying 120. Now let's see. In 2017, remember we issued this debenture. We issued debenture on 1st. When did we issue? On 1st July 2017. We are ending the year on that 1st December. That 1st December 2017. We are ending on that 1st what? December 2017. Therefore, if we issued on 1st July, we shall only pay interest for 6 months. For 6 months. We shall only pay interest for 6 months. In 2017, because we issued on which day? 1st July 2017. Therefore, here, we issued of 1,500 in 2017. It was 1,500 times 10%, yes, times 6/12, times 6/12. Then the whole thing, we have something we call tax shield. times 1 minus 30%. On interest, it means you people, you are not following on our notes. We said on interest, we less that saving, interest tax shield. Interest tax shield. Because on interest, we were not paying what? Tax on it. Therefore, even if we are going to save on that conversion, still we are not going to save that tax element because we are already saving it before when it was at a loan stock. We are already saving tax. Therefore, on conversion, will it affect us? It will not affect us. Therefore, here, I'm going to take 1,500 times 10 times 6 over 12 times 70%. Thank you, Charity. You are saying 52.5 equals to 52.5. 52.5. 52.5. Caroline John, you are saying what? Sam, you are saying 52.5. That is the interest we are going to do what? To save on conversion. Remember, total is 1,500 because in 2017, kindly we did not convert anything. We converted on 1st January 2018. Therefore, in 2017, it was 1,500. But remember, we pay for 6 months because it was issued. We issued the debenture on 1st of what? 1st of July. Therefore, it means, can you pay from January? Like, for example, you want to go and take a loan today. Will you pay for the month of January interest? Definitely no. You will pay interest from when you started to, you took a loan, therefore 52. Then number B, we have incremental ordinary shares. Incremental ordinary shares. Incremental ordinary shares. Incremental ordinary shares, we are going to convert it into ordinary share. I believe we are together there. We are going to do what? To convert it into ordinary share. How are we going to convert it into ordinary share? Our ratio is for every 1,000, you get 25. Therefore, what about 1,500? What about 1,500? But remember, it was 1,500 for 6 months. It was potential ordinary share for 6 months. Therefore, you are going to multiply by 6 over 12 because it was a potential for 6 months. Therefore, here, it will be 1,500 times 25 divided by what? 1,000. Divided by 1,000. Then we multiply by 6 over 12. We multiply by 6 over 12. Why am I multiplying by 6 over 12? Because it became a potential ordinary share on 1st of July. In June, May, crude chini, was I having it? I did not have it. Therefore, it means it was not a potential. It became potential from 1st of July. Therefore, how many shares? 18.75. Thank you very much. 18.75. 18.75. 18.75. Then I go to number C, incremental EPS in that potential ordinary share, incremental EPS, where I'm going to take incremental EPS. Incremental EPS equals to 52.5 divided by 18.75. Incremental EPS, 52.5 divided by 18.75. Incremental EPS ni ngapi? 2.8. 2.8. That is what I have as my incremental what? EPS. Now I'm done with stock option. With loan stock. I'm done with loan stock. Then I come to number 2, potential ordinary share number 2, preference what? Preference shares, preference shares. My potential ordinary share number 2 is preference shares. In preference shares, you give me number A, incremental earnings. That is the dividend I will be saving on conversion. Dividend I will be saving on conversion. Who is a good student to give me the dividend there? I want us to be together. We move together. Therefore, give me the dividend I will be saving there. Dividend that I'm going to save on conversion. Kuka, you are very quiet. Stephen, you are very quiet. How much am I going to save as dividend? How much am I going to save as dividends? Yes, Stephen, you are saying you are around, but you are quiet. You are quiet. You need to make that noise. We are used to that noise so that you make the class lively. You are required to make the class lively. Yes, Carol, you are saying 50, 35, 50, 35. Esther, you are saying 35. Any other person, what we are going to save? 50, John Barasa, 50. Therefore, on interest, remember on interest, we don't have the tax sheet. That is the first step. On interest, on dividend, we don't have the tax sheet. We were not saving tax on dividend. Therefore, it's not a tax sheet. There is no tax sheet there. Therefore, here, we are going to do what? We take 500 times what? Times 10%. Therefore, we get 50. We get 50. We get 50. Therefore, it is 50 that we are going to save. 500 because it was 500 for the whole year, for the whole of year 2017. Why are we just taking 500 times 10? Because it was issued in the year 2015, which means in our year of 2017, it was there for the whole year. It was there for the whole year. We are only going to consider convertible preference shares, and I already explained convertible preference shares there. Convertible preference shares, that is what we are going to consider there. Because redeemable preference shares, are we going to convert it into ordinary share? We are not going to convert redeemable. Therefore, here on redeemable, are we saving that dividend? We are not saving. We shall continue paying it until we buy it back. Remember that one, we shall buy it back. We shall not convert into ordinary shares. Therefore, that one is, we shall reduce. Remember, when we buy it back, we shall be reducing that liability. But convertible, we are going to save it because we shall convert into ordinary shares. We shall convert it into ordinary shares. Therefore, we go to number B. Number B, we have incremental ordinary share. Incremental ordinary share. Incremental ordinary share. Incremental ordinary share. Who can give me the ordinary share that we are getting? Ordinary shares. Kindly someone to give me ordinary shares there. Ordinary shares. I need 5. Carl, you are saying 5. Thank you very much. Thank you very much. You are saying 5. Stephen Kuka, what is your ordinary shares you are getting from preference? Felista, you are saying 5. Thank you very much. 5. Everyone is saying 5. It seems it is 5. 5. Sarah Simbiri, you are saying 5. Therefore, we are saying for every one preference share, you get one ordinary share. For every one, you get one. Therefore, what about 500 divided by 100? What about 5 million? 500 is in shillings. The bar value is 100. Therefore, what about 5 million? Therefore, it will be 5 times 1 divided by 1, which is 5, which is 5, which is 5, which is 5. Thank you very much. We have 5 there. Then you give me the incremental number C. Incremental EPS. Incremental EPS equals to 50. This 50 divided by 5, which equals to 10, which equals to 10. Equals to 10. Thank you. That is the incremental EPS. Then we are done with number 2 preference shares. We are done with number 2 preference shares. Any question on preference shares? We are done with preference shares. We are done with preference shares. We are done with preference shares. Now we go to our potential number 3. Number 3, stock option. Stock option is our number 3. Stock option is our number 3. Stock option is our number 3. Are we there on stock option? Number 3. They say that meanwhile, on 1st April 2018, the company granted, that happened in 2018. Therefore, here we are considering 2017. Stock option happened in 2018. Therefore, that one we shall put it in the 2018. Therefore, we are done with 2017. We are done with 2017. Stock option were issued in 2018. Therefore, in 2017, was it a potential ordinary share in 2017? Definitely no. Why is it no? Why is it no? Because it was issued, it was granted in 2018, which means in 2017, we did not have it. I believe the concept you are getting it. In 2017, we did not have those stock options. Therefore, it was not a potential to us because we had not even promised. But in 2018, we promised. Therefore, that one we are not going to include it. We are not going to include it in 2017. In 2017. Therefore, here we rank them. We rank them. Step number 2, we said you rank the potential ordinary shares. Which one has the highest incremental EPS? Which of the two, convertible loan stock and preference shares, which one has the highest incremental EPS? 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 Preference share is the one that has the highest because it has 10. It has 10. Therefore, here it means that this is our rank 1, the most dilutive. The most dilutive is what? Is the loan stock because it has the lowest incremental EPS. It is the most dilutive. But this one is the least. This is our rank 2. Rank 2, the least dilutive. Rank 2, the least dilutive. Therefore, this one is the most dilutive. This one is the least dilutive. Sometimes, good friends, and listen to this carefully. Listen to this carefully. Examiner will ask you to compute the anti-dilutive potential ordinary shares. Anti-dilutive. Now, the anti-dilutive potential ordinary shares, these are the shares that has the most highest incremental EPS. Like in our case, 5 million shares are anti-dilutive. Why are they anti-dilutive? Because they are giving us the highest incremental EPS. Examiner in many questions has asked, compute requirement number A, compute basic. Number 2, compute the anti-dilutive potential ordinary share. Therefore, in such a case, if you are required to compute the anti-dilutive, you will do the same procedure, but I pick the one with the highest incremental EPS. Those shares are anti-dilutive. And we said, what is anti-dilution? That one you will answer by yourself. Therefore, let's dilute our EPS in 2017. Diluted EPS. Let's compute the diluted EPS in 2017. Let's compute the diluted EPS in 2017. We say particulars. 2017. Let's compute our EPS in 2017. Diluted EPS in 2017. You say particulars. Earnings. You say earnings. Then ordinary shares. Then EPS. We want to dilute to see the effect. How will our EPS look like in future from 2017? We say particulars, earnings, ordinary shares, and EPS. Then we begin with our basic EPS. Basic earnings. Basic earnings was 400. Those were the basic earnings. Then basic ordinary share was 20. Our EPS was 20 without restatement. The EPS was what? 20 without restatement. We take the basic EPS, which were earnings were 400, that powers 400, ordinary shares 20, then EPS was 20. EPS was 20. I believe we are together there. Then we come to our rank 1, loan stock. Now, what is our saving there? Our earnings, extra earnings, incremental earnings, it was 52.5. Incremental earnings was 52.5. We come to add. Then on ordinary share, we add 18.75. Ordinary share that we converted. Ordinary share that we converted. 18.75. Extraordinary shares. Extraordinary shares. Then we come to rank 2. Preference shares. Preference shares is our rank 2. Preference shares, we have earnings of 50, ordinary share of 5, incremental ordinary share of 5. Therefore, we add them. We add them and divide. You add them and divide, then you give me the diluted EPS. We are taking the earnings from basic. Earnings from basic, which was 400 in 2017. We add the saving on interest we are getting this year. Then we add also preference what? Share we are saving, preference dividend. Then we convert, we add the shares there. What is our total here? Our total here is 542.5. Hapa our total ni ngapi? 40 what? Is it 43 point what? 43.75. Therefore, you give me the EPS there. My EPS, 11.49. 11.49. That is the diluted EPS in 2017. Diluted EPS in 2017. If you are floating, you say, I'm floating. If you are floating, kindly you say. If you are not getting anything, that is, you say, so that tunakushughulikia. Okay, let's go to 2018. Let's go to 2018. Let's go to 2018. Let's go to 2018. 2018. 2018, kindly, if you are okay with 2017, let's go to 2018 and discuss EPS in 2018. EPS in 2018. Still, we have our dilutive factors. These dilutive factors, convertible instruments, still we have them. Therefore, what we are going to identify, our convertible instrument, potential ordinary shares, potential ordinary shares, in 2018, potential ordinary shares in 2018. What we have not converted into ordinary shares, it is called potential. Somewhere you are saying that floating but tuendelee tu, and I guess you are saying hapo leo nimesink, hapo leo nimesink. Let's continue. Somewhere you are saying you are floating, but let's continue. Therefore, I believe here you are going to get the concept here in 2018. Therefore, what are our potential ordinary share in 2018? Potential ordinary share in 2018. Remember, in note number 2, still we have convertible loan stock. Our potential ordinary share number 1 is convertible loan stock. Somewhere, are you seeing convertible loan stock? Somewhere, are you seeing convertible loan stock? Convertible loan stock. Victor, you are saying leo nimepata convertible loan stock. Yes, we have convertible loan stock. On convertible loan stock, still it's our potential ordinary share. We compute the incremental earnings. Number A, incremental earnings. Incremental earnings 2018. Incremental earnings, that is the interest we are going to save. Now, I want you guys to give me the earnings we are going to save, interest we are going to save in 2018. The interest we are going to save in 2018. How much is the interest are we going to save? How much is the interest we are going to save in 2018? The incremental earnings. How much is the interest? Yes, Kari, you are saying 120. Thank you very much. 120, Felista, 120. Thank you very much. Any other? 84. Thank you, Charity. 84. Thank you. Mesh keep 84. Caro, you are saying 84. Johnny Barasa 84. Thank you very much. Thank you very much. Remember Stephen Cooker 84. Thank you very much. Remember in 2018, our loan stock is 1,200 after converting 300. It was 1,200 as at the beginning of the year. Therefore, if I'm to pay interest, I will pay on 1,200 times 10%, I get, then times 1 minus 30, tax shield. On interest, we said we factor in tax shield. We factor in tax shield. Therefore, it will be 1,200 times 10 times 30. I believe you are getting 84. That is correct, 84. Thank you very much, Linda Wanjira. Thank you. Then number B, kindly give me the incremental ordinary shares. Incremental ordinary shares. Ordinary shares. Give me the ordinary shares in 2018. Incremental ordinary share. How much are we getting as the ordinary shares there? How many ordinary shares are we getting from the conversion in that potential ordinary share? You are saying, John Barasa, you are saying 30. Thank you very much. Any other person? Any other person? How do we get 84? How do we get 84 is 1,200. It is here. 1,200 times 10% times the tax shield, that is 70%, times 70%. 1,200 times 10% times tax shield, we get it there. Purity, you are saying 30. Thank you very much. Now, for every 1,000, you are going to get how much? We are going to get 25. What about 1,200? Therefore, it is 1,200 times 25 divided by 1,000. I believe that's why you are telling me 30. I believe so. Then number C, incremental EPS. Incremental EPS, which equals to 84 divided by 30. 84 divided by 30, how much do we have there? 2.8. Thank you very much, 2.8. Then we go to preference shares. We go to preference shares. Kindly help me the preference shares. On preference shares. Same on preference shares. On preference shares. On preference shares. Give me on preference shares, you give me the incremental earnings. Incremental earnings. Incremental earnings on preference shares. What we are going to save on conversion, John Barasa, you are saying 50. Thank you very much. Caro, you are saying 50. Thank you very much. Therefore, it is 500. Because we did not convert anything, 500 times 10%. Therefore, equals to 50. Thank you very much. Then number B, incremental ordinary shares. Incremental ordinary shares. Ordinary shares. Samsam, thank you very much. Alice Macau, thank you very much. Give me the incremental ordinary shares. How many ordinary shares are we getting from the conversion? How many of ordinary shares are we getting from conversion? 5. Thank you very much. 5. 5. Thank you very much. 5. Thank you very much. Because it is still 1 for everyone. What about 500 divided by 100? What about 5 million? Equals to 5 times 1 divided by 1, which is 5. Then number C, incremental EPS, which equals to 50 divided by 5, which is 10. Incremental EPS is still 10. Then we go to number 3 now. Number 3, stock options now. Stock options. Stock options. Stock options, number 3. Here 1-to-1 tunatoa wapi? Purity, you are saying here 1-1. Soma note number 3, Purity. They say convertible preference shares were issued in the year 2015 One convertible preference share is entitled to one new ordinary share. One convertible preference share is entitled to one preference share. Therefore, that is where we are getting it, purity. That is where we are getting it. Therefore, here, stock options. Who can give me the incremental earnings? Incremental earnings on stock options. Who can give me the incremental earnings? Obaria, you are saying 0. Thank you very much. 0. Why is it 0? Because on stock option, we are not meeting any expense. There is no expense we are paying on stock option. Therefore, we are saving nothing. We are saving what? Nothing. We are saving nothing. We are saving nothing. We are saving nothing. Thank you very much, Johnny. Barasa, you are saying 0. Thank you very much. We are saving nothing. Then give me number B. This is number A. Number B, incremental ordinary shares. Ordinary shares. Incremental ordinary shares on that item. Incremental ordinary shares. I need incremental ordinary shares. How many ordinary shares are we getting from that stock option? Incremental ordinary shares. How many ordinary shares are we getting from that ordinary shares? Incremental ordinary shares. How many ordinary shares are we getting? We are getting 4 million. John Barasa, 4 million. Thank you. Caro, you are saying 5. Thank you very much. 5. Thank you very much. Any other? Charity. Charity, you can also put your effort there. Let's recognize you. Say something there. Ordinary shares that we are getting from that. Remember, in that note, let's read the note together. Let's read the note. Let's read that note. Meanwhile, on 1st April 2018, the company granted its employees the option to buy 4 million ordinary shares at a strike price of 120 per share. No employee had exercised their right by that 1st December 2018. The average market price of the ordinary share during the year 2018 was 125. Now remember, good friends, we are giving employees shares, but they will buy at shillings 20 instead of shillings 25, 125. They will buy at shillings 120 instead of 125. Therefore, it means that although I'm giving you shares, but we will also pay something. Therefore, in stock option, kindly, in stock option, we say we have number A, shares at full market price. Shares at full market price. Market price, these are not dilutive, not dilutive. Not dilutive, therefore they will not appear. They are not dilutive. Therefore, we don't include them in the computation of, we don't include them. Kindly listen to this because no one is getting it there. We have shares at full market price. Therefore, those shares are not dilutive because we are getting resources. We shall be getting money to invest in the company to increase our income. Therefore, they are not dilutive. But we have number B, bonus. Bonus we are giving. Therefore, shares at full market price. Bonus is the dilutive one. Dilutive. Bonus is dilutive. Therefore, shares at full market price is not dilutive there. Therefore, how many shares are there at full market price? It is 4 million times 120. They are paying 120 out of 125. These shares are not dilutive. These shares are not dilutive. How many shares are there not dilutive? 4 million times 120 over 125. Shares at full market price. Sinakuwa ngapi? Shares at full market price. 3.84, thank you very much. 3.84, thank you very much. Then, those shares are not dilutive, 3.84. Those shares are not dilutive. But the bonus element is shillings 5 per share, shillings 5. Therefore, bonus will be 4 times 5. I'm giving you 5 for free over 125. How much is the bonus element there? How much is the bonus element? How much is the bonus? 0.16. 0.16. That is the bonus we are giving them. The bonus we are giving them. But that is what will be dilutive. That is what will be dilutive. Therefore, when we are computing diluted EPS only, and that one you can write it down, only you include the bonus element. Shares at full market price, they are not dilutive. Therefore, you don't include them. Therefore, this 0.616, when did it become potential in the company? Was it from January or April when they became potential in the company? Is it from January or April? Samsam, you are saying repeat bonus calculation. Now, I was giving you shares, Samsam. I was giving you shares. What is the market price of the shares? What is the market price? Market price is 125. But I'm giving you shares at which price? I'm giving you at 120. What does it mean? I'm giving you shares at a discount. Discount of how much? Of 5. Discount of 5. Therefore, that discount is what we are calling a bonus. Therefore, how do I compute? You take 4 million shares times 5 over 125 over the market price. You get the discount. That discount is what we are calling the bonus. Then, when did we issue this item? When did we issue? When did we issue? When did we grant to these employees? When did we promise them that we shall give them shares? We promised them, Caroline John, not on January. Not on January. We promised them, meanwhile, on 1st of April, the company granted its employees. We gave them on 1st of April. Therefore, it means it became potential on 1st of what? April. It became potential on 1st of what? April. That is when I told you as my employees, okay, from today, I will be giving you shares. Therefore, that one is when I promised you. It became potential from that day, not from January. Therefore, we weighed them times 9 over 12. When it became potential ordinary share, 9 over 12, 9 over 12, 9 over 12. It became potential from April. Therefore, 9 over 12. 0.12, Charity, thank you. 0.12. That is my ordinary share. That is my ordinary share there. I think bonus should not be weighted. It's a good question, Oparia. But remember here, we are looking at potential elements. Potential elements. When did it become potential? From 1st January, I had not promised you. From 1st January. Therefore, I'm looking at the potential ordinary share. Now, we said in our notes that it became potential from the beginning when I issued it, not from 1st January. No, it became potential from when I issued it. When I granted you is when you had a right. You had a right from when I granted. From January, you do not have right. That right. You received the right from April. That's why we are waiting it from April. I believe you are okay there. That's why it became what? And I will repeat. Remember here we are talking about potential. If it is a normal, kindly listen to this. If it's a normal EPS, basic, you don't wait. But here, from 1st January, you did not have the right. You did not have the right on that share. You did not have the right on that share. You did not have what? The right on that share. Therefore, I'm just checking what is the effect from when I promised you. That's why we are waiting that on time basis from when I promised, from when you got the right. Therefore, my incremental number C, incremental EPS, incremental EPS equals to 0 over 0.12. Therefore, 0. It comes to 0. Incremental EPS comes to 0. Incremental EPS comes to what? To 0 there. Therefore, we come to rank them from the most dilutive to the least dilutive. After we are done with all those items, we come to rank them from the most dilutive to the least what? Dilutive. Therefore, the most dilutive is what? Increment is the stock option. This is our rank 1, the most dilutive. Rank 1, most dilutive, because it's coming with 0. Rank number 2 is this one, rank 2. Loan stock is our rank 2. Then rank 3 is, this is our rank 3. Therefore, examiner will ask you sometime anti-dilutive potential ordinary share required. Compute the anti-dilutive. You will use the same procedure. Therefore, 5 million is, those shares are anti-dilutive. 5 million anti-dilutive. 5 million anti-dilutive. 5 million is anti-dilutive. Anti-dilutive. Therefore, we have them. Now we compute the diluted EPS. Let's compute the diluted EPS 2018. Diluted EPS 2018. Diluted EPS 2018. Let's compute diluted EPS 2018. 2018. Therefore, you say particulars, earnings, ordinary shares, then EPS. EPS. Here, earnings, we have basic. Basic, we had 600 as our earnings. How much was the ordinary share for basic 2018? 2018, ordinary share for basic. Ordinary share for basic, it was how many shares? It was how many shares? Basic, ordinary shares? 2018. Basic ordinary shares 2018. 31.67. Basic ordinary shares 31.67. Then what was the EPS? EPS, I think it was 18 point something, 18.95 something. That was the basic EPS. Now, our rank 1, we come to rank 1, stock option. Rank 1 is stock option. Rank 1 is stock option. How much is our incremental earnings? Incremental earnings is 0. Incremental earnings is 0 on stock option. Incremental ordinary share is 0.12. 0.12. That's our rank 1. Incremental earnings is 0. Incremental ordinary share is 1.2, 0.1.2. Rank 2, our rank 2, we come to loan stock. Loan stock, rank 2 is loan stock. Rank 2 is loan stock. What was our incremental earnings in loan stock, on loan stock? Incremental earnings on loan stock, I think it was 84. This one was 30, if I'm not wrong. 8430. Thank you very much, Charity. Then rank 3, preference. Preference, it has 50, it has 5. Therefore, you add and divide. You add and divide. Then you give me the diluted, fully diluted EPS there. You add and divide and give me the fully diluted EPS. And that is the end of that question. What you are supposed to do, I think we have highlighted the important things in EPS. 10.99, thank you, Felista. 10.99. 10.99. 10.99. Now, if I'm just to clarify on 1-2 items, sometimes, good friends, the examiner Sometimes I just want to clarify 1 or 2 items, then we are done with the EPS kabisa. Sometimes the examiner will give you 2 profits. Sometimes the examiner will give you 2 profits. 2 profits. Sometimes the examiner will give you 2 profits. One from the continuing operation. Another one from discontinued operation. Discontinued operation. Sometimes, good friends, examiner will give you 2 profits there. One from the continuing operation, another one from the discontinued what? Operation. Like for example here, continuing operation profit amekupatia 20. Discontinued operation profit amekupatia 30. Kindly listen to this, is very important. Sometimes examiner will challenge you on this. We have the continuing operation. That is in a group scenario. In a group, remember, you can acquire a subsidiary. I believe you have done group accounts with Mr. Aura. You have done a disposal of shares, I believe, in a group, disposal of shares. Therefore, you can be given those 2 profits, continuing operation and discontinued operation. Now, in a continuing operation, we have 20, for example, our profit. Discontinued operation, we have 30. Therefore, when I'm computing basic EPS, you use pot. You take pot profits. That is on discontinued. It will be 20 plus 30, which is 50. If I'm computing basic EPS, I believe we are okay there. If I'm computing basic EPS. But if I go to diluted EPS, I will only use profit from continuing operation. Only use profit from continuing operation. Only use the profit from continuing operation. That is very important. Sometimes the examiner will give you 2 profits. He gives you the profit of the continuing operation, the profit of the discontinued operation in the same year. Therefore, in that case, when I'm computing basic EPS, I will use 50. But when I go to diluted, like here in the example here, I want to compute diluted. Therefore, diluted here, my profit, I will only use the continuing, therefore, I will take 20 there. I will not take 50. I will take profit of the continuing operation only. I will take the profit of the continuing operation. And I believe we will split that gospel to those who are not with us so that they don't miss a mark on that one. If you are given continuing operation, discontinued operation, only consider in the basic, you use pot profits because we are checking on the exact EPS for the year. That is the profit we have. Also from the discontinued. Remember, to discontinue means it will not be there in the next year or the other year. Therefore, we shall not have that profit. But in the basic, we have it. We are computing it today. That is. But in the future, we will not have that profit. Therefore, for diluted, you don't include it. For diluted, you don't include it. What of ordinary shares? Ordinary shares, examiner will not give the ordinary shares of the discontinued operation because at the end of the day, we are just one company. We are just one company with one ordinary share. Therefore, the ordinary share will just be one. It will not be the ordinary share for the continuing, ordinary share for the discontinued. No, we shall just have one ordinary share. We are only just discontinuing like a branch, like a subsidiary. Therefore, remember the subsidiary, when you are consolidating the subsidiary, do you take the shares of the subsidiary to consolidate? In a group, when you are consolidating group accounts, when you come to ordinary shares, do you take the ordinary shares of a subsidiary? You don't take them. Therefore, you only use the ordinary share of the parent subsidiary, a parent company. I believe you have done group. Therefore, remove that 2019 question. Remove that 20. To remove which 20 now? Remove this one. We are saying we remove it. 2019 question. This was 600. Or what are you asking? Or what are you asking? Stephen Cooker, you are saying remove that 20 in 2019 question. I believe so. That's what you are saying. Or you can come clear. I'm not getting it. Therefore, for today, I think we shall stop there. I thought we shall introduce financial assets and liabilities, but because of time, we are not going to introduce. Therefore, we shall just do it tomorrow. Therefore, tomorrow we shall be doing financial assets and financial liabilities. That is the topic we skipped on our topic number one. Topic number one, assets and liabilities, financial assets and financial what? Liabilities. But I believe we are going on well with group accounts. So for us, we shall only do the cash flow statements, but also we shall revise 1 or 2 questions in group, but main agenda will be the cash flow statements. Then we are almost finishing our everything because we are only remaining with one topic and theory. We are remaining with preparation of financial statements of other companies, and that is insurance, banking, and I believe those are the major ones. Those are the major ones, banking and insurance. Then the rest is theory. The rest is theory. Then we are almost finishing. In the next 2 weeks, we shall be done. In the next 2 weeks, I believe we shall be done with everything in the next 2 weeks. Therefore, you don't have to worry. You don't have to worry. You don't have to worry. Shem, you are saying, Obaria, you are saying leases. Leases we did. Unless you say we revise. What of fair value measurement? Fair value measurement, Stephen, we shall do it. It's a theory. Fair value measurement is a 1-page theory, how to get the fair value of an asset. We shall do it. Leases, we already did. Shem, you are saying, thank you for revising that question with us. Stephen Cooker, you are saying, what of fair value measurement? That one I have said is theory. I joined late. I hope to get the video, Mwalimu. The video of this one, you will get it. We recorded. Therefore, I believe our administrator will have to give us. Caleb, you are asking segmental reporting. We shall just revise on it. Already you did with Dr. Aura. You did it. Therefore, we shall just revise in our revision because we shall have time to revise. We shall have to just revise 1 or 2 questions on segment. But you already did. Your comrades have the notes. We will need revision of the first topics for those of us who joined midway. We shall revise everything. We shall revise everything because we shall have like 2 weeks to revise. I'm saying in like 2 weeks to come, we shall be done with the syllabus. Therefore, come 15th, God willing, come 15th of March, we shall be done because for us, we are only remaining with insurance, banking. Then we do cash flow. Insurance and banking, that's a one-day lesson. Insurance banking is a 1-day lesson. Then tomorrow we are doing financial assets and financial liabilities. The rest is theory. Theory we shall be discussing small items. Then we just read. Obadia, you are saying September 2021. Answer that one. If I have time, I will do it. I post it for you. I will do it. Then I post. If I have time, that is, I will get time and do it. I post for you. But you also need to revise. Miri, you are saying fair value measurement has always been set for most all 4 past sittings. Kindly send us good notes on it. Yes, fair value measurement, you are just required to know how to measure fair value measurement for 3 levels of measurement. 3 levels, we have level 1, level 2, and level 3. It has been there. Financial statements in hyperinflationary economy. Those are just the small adjustments on financial statements. We need just to know the index on how to measure them, but mostly it is theory, and to know how to adjust them. But you will not be given a question to adjust. That's what I know. You will be just required to know how to adjust using the index. That is the best, the thing they can ask you. And what are the theories? What are the characteristics of a hyperinflationary economy? Then how do you adjust? Remember, you have the index of that inflation. Therefore, it's nothing much. It starts at 30 minutes something. Therefore, kindly, let's meet tomorrow, God willing, and we shall have to discuss financial assets and financial liabilities. But what I encourage you, revise, kindly revise, so that you don't be caught off guard. Revise as many questions as possible. Revise as many questions as possible to internalize the concept. Like I have realized some of you, when we left, you have never even opened a book to revise on EPS. That is very dangerous. How can we get past notes? How now that we joined late? You can liaise with your comrades to get notes. Thank you very much for your time today. Let's meet next time.